Why are so many economists and market watchers worried about this chart right now? This is something called a yield curve, and it plots the interest rate that you're expected to get on a bond based on the maturity that you buy that bond for. Right now, what it shows is that if you buy a longer term bond, you'd actually get a lower interest rate than if you were to buy a shorter term bond. That's a little bit abnormal. Historically in the US, when the yield curve is inverted like this, it's actually been a pretty strong indicator of recessions. According to the Federal Reserve Bank of San Francisco, when the US Treasury yield curve has inverted, we've gone on to have a recession within 24 months, 10 out of the last 11 times that it's happened since 1955. This might be why we're hearing so much about it in the news right now. So as an investor, does this mean it's time to run for the hills? Maybe not. According to information from US News and World Reports that was published on July 31st of 2023, along with information that they compiled from the St. Louis Fed, although the yield curve has been a great predictor of recessions, it's not been a great predictor of the timing and also the depth of economic downturns. Also, what's surprising to a lot of people is that 8 of the last yield curve inversions, which have occurred since 1965, have actually resulted in a median return on the S&P 500 index of positive 8.5%.